Welcome back, my dear students. Welcome back, everyone. Welcome back, my dear students. Welcome back, everyone. Here we go for the third lecture today regarding the accounting as well. And where we stopped, we'll resume working it. And I told you before, let's remember together what we said before. We said that the owner's equity will equal, or the other name for the owner's equity is the capital. So owner's equity, or you can say capital, and this will equal the assets minus the liabilities. And we talk about the assets, and we said that the assets, anything that the business owns. And we said the liabilities are anything that the business owes, not owes. Any debts, like as example, the credit line, the mortgage, all these credit cards, all these are examples for liabilities. Then we say the personal net worth. Here is a list of my assets: house, car, furniture, cash in bank, saving, RRSP, the teacher's pension plan. And so those personal net worth, this all also, this is the assets. What have been before is the assets, like personal net worth are the assets. These are my assets. It's exactly like the company. The company is considered as entity and it has also its own assets and it has also its own liabilities. Like here as well, here is a list of my liabilities: mortgage, credit card, and so this is what I owe, OWE, but not what I own. What I own is here the assets. The assets is what I own: car, furniture, house. But the liabilities is what I owe, means what I have to pay for the others, like the debts, liabilities, credit card, all line of credit, all these are liabilities. So we have what? Both of them here right now. Personal net worth. So the personal net worth is the gap or the difference between both of them. What do I need to do to calculate my net worth? Exactly all my assets minus my liabilities. It will be the total assets minus the total liabilities. So this is my net worth. Personal net worth, we can see like this. I told you before, it's the balance sheet for a human. It's like a balance sheet for a human. So your net worth, make a list of all what your assets and your liabilities. Calculate your total assets and your total liabilities. Now calculate your net worth. Make a new net worth statement of your own sense. The balance sheet. What is the balance sheet? Now we'll go, because the net worth is your balance sheet. It is considered your balance sheet. The balance sheet is a statement of financial position. Liabilities will equal is the debits, and the owner's equity or the owners of shares of the assets, so equals that will be the things owned. So like we said before, assets will equal liabilities plus owner's equity. I told you this before, and we said also, even if you want to take some one of them out the other side, so owner's equity, we call it the capital, will equal the assets minus the liabilities. That will be the owner's equity. So here, assets will equal liabilities plus the owner's equity. The balance sheet, a freeze frame of a snapshot with the business owes, and the owner's invested interests. A financial picture of the business at the point of time. The balance sheet does not indicate whether a business has made a profit, only whether it is financially strong. So the balance sheet will tell me what is my financial situation in a particular moment. That's the meaning of the balance sheet. My financial situation in a particular moment. Features of the balance sheet. The balance sheet looks like the fundamentals accounting equation. So assets will equal liabilities plus owner's equities. So this is also the balance sheet. It's the same. the assets on one side and liabilities and both and owner's equity on the other side. A three-line heading is used who? The name, features of the balance sheet, the name of the individual or business or the organization. What? The name of the financial statements. So the financial statement, was it is the balance sheet, owner's equity, or so on. When? The date. So we have to write a date also for the balance sheet. I'll just show you now a balance sheet, how it looks like. So the first thing is the cash and liquidity. Cash is the most thing in the balance sheet. Cash is the most liquid things. So the assets are the ownership, title larger is separated with assets you sell, give away, and all this. There's nothing here, categorizing assets. So assets, we can say they are both two kind of assets, fixed assets and current assets. So the current assets are things owned and disappear quickly. Let us say what you own sorry about that. Sorry about that, my dears. So we say, what is the assets? The meaning of the assets, that all these, we have current assets and fixed assets. What is the difference between the current and the fixed assets? The current assets are those assets which, like the cash, the inventory, the account receivables. Those, we say, they start in the business in a figure of money, and they return back to the figure of money within 360 days. This is the meaning of it. It can be liquidized. By other meaning, we can switch it into money. Like the inventory, we sell the inventory and cash money. So it's including also the money. So all included, like money, uh, the any account receivable, like the checks, bills of exchange, or whatever. Any debits accounts also is there. And we have also the inventory is there, the raw materials. Those all, we call them current assets. Okay. Usually the current assets, like you see here, disappear quickly. It doesn't disappear means it's gone. No. The word disappear here means change into money. Switch it into money. This is the meaning of disappear here. Usually in less than 1 year. A long-term assets, like I told you, A long-term assets or the capital assets or fixed assets, assets that business keep for a long time. That's true. Assets that a business keep for a long time. Yeah. So assets in order of liquidity, assets include cash, bank balances, account receivables, leased in alphabetical orders, inventory and suppliers, and furniture, equipment, fixtures, vehicles, property, and building listed in order in which they will be used up. So in order of liquidity, assets include cash, bank balances, account receivable, listed in alphabetical order, inventory and supplies. Also, these are assets, furniture, equipment. So the fixed assets are those kind of assets that you buy it not for the purpose of selling it back. So it's for, you buy it because you want these assets to generate for you profits, but not for the purpose of reselling it back. That's why we call it assets. And fixed means that it's helping you to generate profits. Okay, so let's say as example, you brought a vehicle. So the vehicle is helping you to run your business and to make profits. So this is a fixed asset, but it's for the dealer, the auto dealer. It's not a fixed asset, it's a current asset. Why? Because he brought this cars to resell it back. He brought it to resell it back. For that reason, it's for him a current asset. But for you, for other people who buy these assets like a car and they keep it to run their business, in that case, it's fixed. So again, the fixed assets are those which you buy to run your business and not for reselling back. This is the fixed assets. Meanwhile, the current assets are those assets you buy it, and in your intent to switch it into inventory, you switch it into receivables, you switch it into any kind of the raw materials, you switch it into supplies, you switch it into account receivable, and you are expecting that it will return back into the figure of money within 360 days. So account receivable is one of the current assets. Account receivable is one of the components of the current assets. And I will just show you right now, we are on slide 31. Let me go and show you a balance sheet, a figure of a balance sheet, so that you will know what is the meaning of the balance sheet. Here, let's see, to be clear when we're talking. So the balance sheet, the idea of the balance sheet, that the total assets in one side equal, like we said, total liabilities and the owner's equity. The owner's equity, we said this is the capital. So assets will equal liabilities plus capital. Assets will equal liabilities plus capital. Same thing we said here before. So if I want the capital, it will be assets minus liabilities. Okay, assets, if I want to get the assets here, I can get it here. And the capital here, it will go there. Okay, so assets will equal liabilities minus capital. Liabilities minus capital. So here, that is the equilibrium of the, and we see it also before here. Let me show it to you again. We said here before about the accounting equation. And we see, here we go. Let me show, here we go. Like I told you, assets will equal liabilities plus owner's equity. That is the same here, like the example which we had here. Here we go. Let me get you back. Here we go. assets will equal liabilities plus owner's equity. Consequently, if you want to take some one of them to the other side, that will be easy. And you change it since you will pass the equation. The positive will be negative and the negative will be positive by the same meaning or by the same way we did before. So I return it back the way it is. Here it is in the start itself. Owner's equity is the capital will equal the assets minus the liabilities. Then we can change it back the way we want. So if I want here now to take the liabilities this side, the other side, if I want to take it, then that will be positive because it was negative here. So you will change it into positive. So it will be both liabilities plus owner's equities will equal the assets. So it depends on what you want to do. Depends on what you want to do. Now we know what is the meaning of, let us see here is a figure of the balance sheet, and there is a separated video for the balance sheet. Here we will talk about it. Here is the assets, we usually write it on the left side and the liabilities on the right side. Since we started here with the current assets, then here will be the current liabilities. We have here the current assets, here the current liabilities. So the current assets will be cash, account receivable, inventory, prepaid expenses, investments. These are the assets. Meanwhile, the liabilities, if you have in the assets account receivable, then in the liabilities, there must be account payable. There here notes receivable, then here notes payable. Here, prepaid expenses means that you paid it in advance. Prepaid expenses means you paid it in advance. Like as example, if a plumber is coming to do work for you, and you give them $4,000 to fix your taps and your sinks and everything and bathtub and everything, then you give it and they didn't work yet, but you give them the money in advance. This considered an asset prepaid because it's also already owned to you. So prepaid expenses. But here, let us opposite the case now. Suppose that a worker did work for you with $5,000, and you told him now, I don't have money, so I will pay for you later after 1 month or 2 months or whatever. So this is accrued expenses, which you didn't pay yet, It's deserved, it is due, but you didn't pay it yet. Here, the investment, here, the deferred revenues. Also, long-term debts here in the current liabilities. Okay, or long-term loans. You can say long-term loans if you want. Here, the fixed assets. Fixed assets, we said the fixed assets are those assets which we buy, not for the purpose of selling back, but we buy it to run our business. It's helping me in generating profits, but I didn't buy it to resell it back. I didn't buy the land to resell it back, but I bought the land because the land will help me. I will build my factory on this land. So this will help me in making profits. Building and improvements also. The building also, it helps you in making profits. So this will be fixed assets. Equipments, cars, machines, forklifts, whatever. These are all also fixed assets. Less accumulated depreciation, and we will talk about depreciation here. In one of the chapters, we would say, what do we mean by the depreciation? Depreciation means that you reduce in the amount of the asset itself. You reduce in the amount of the asset. As example, assets is when you buy it is not like after 4 years. So there is depreciation, and we will calculate this depreciation using many ways that would be part of our studies in the next lectures. Okay, here on the other side, here in the shareholders equity or the capital, we have common stocks, additional paid in capital, retained earnings, and treasury stocks. So those, we call them shareholders equity, That's the point which we see here. So here we have now the assets, and here we have the liabilities. And usually we call it balance sheet because both the sides are equal. Like you see here, both the sides must be equal. What you own is what you owe. So both the sides must be equal. That is in And you can see here the capital or owner's equity. We call it capital again or owner's equity. It includes the common stocks, additional paid in capital. So as example, you increase your capital. You started working with investments 300,000 and you will increase them to 500,000. So this 200,000 we say additional paid in capital. That means that you increase your capital, you increase your investment. This is also owner's equity. Retained earning. What is the retained earning? The retained earnings are those kinds of profits which you don't divide it. At the end of each year, the business, when they do profits, they divide the profits on the in either on the workers or the employees who are working in the plant. They divide the profits there on them, or they divide parts, give part to the employees, and another part they put it in expansion, like they want to expand their business, they want to increase, they have new unit plants, they are planning to build a new unit, and so on. So part of it is retained and part go for further investments, which means additional paid in capital if they will put further investments. These are the two sides of the assets and the liabilities which configure the balance sheet. Okay. How about if this side is greater than this side? In that case, I will put capital here. I will make them both equal, and I will add the capital in this side because since this side was less than this side. Okay, what about if this side was greater than this side? If the liabilities were greater than the assets, in that case, I will put the liabilities and equal the assets, and I will see this side is greater and this side is less. So let's say this one was 100,000 and this is 80. So the 20, the balance between 100 minus 80 is 20. I will put it here under the name intangible assets here, or the goodwill. I will put it for the goodwill. So I must balance both of them like we will see in the examples I'm just now referring to, but I'm not saying in details because we will come back in very detailed lectures for doing, and we will take exercises how to do the balance sheet as well. So, but for the moment, I'm just showing you what do we mean by the balance sheet so that you can know what is the meaning of our balance sheet. That is the first point today. That is the first point today. So that was about the balance sheet. Don't forget, the balance sheet is in a T form or report form. The T form is usually like what I showed you. The assets on one side and the liabilities are in one side. These are the, this as example, this is now an example for how to do the balance sheet and the liabilities, and we will take this by the next lecture. But what I want you to do now, we said, what is the meaning of the accounting equation? And we said that the liabilities will equal, assets will equal liabilities, assets will equal liabilities plus the owner's equity, like I told you before. Nothing new here in this lecture, except referring to the meaning of the balance sheet. All I will tell you now is a question, new question for today. We will say 7, draw a balance sheet. So you will draw a balance sheet with its components. You will draw a balance sheet using its components. What are the components of the balance sheet? And this is a question. And refer to its content. And refer to its content. Sorry about that. And refer to its content. So you draw a balance sheet and refer to its content. This is the first question. Draw the accounting equation. Control and C. And here we go, Control and V. And the second question. Now take the questions down here so that here, draw the second question, draw balance sheet and refer to its contents. Then the third question will be here for today is discuss the following. This is question 8. Discuss the following meanings. The following meanings. Fixed assets, fixed liabilities, current assets, and current liabilities. So tell me the meaning of what's the meaning of fixed assets, what the meaning of fixed liability, what the meaning of current assets, and what the meaning of current liabilities. Those are the two questions actually which we'll work on today. Those are the two questions which are the main topic ideas of our working today. So I will give you around 5 minutes here to work on these questions, please. Let us do it. Let's work on this question. Thank you so much. I will give you about 5 minutes. Then we'll stop the video and go to a new lecture. Thank you so much. So today we'll talk about what is the meaning of balance sheet, and we saw the balance sheet components. We saw the components of the balance sheet, and I showed you an example of a balance sheet here. We went to an example for the balance sheet actually. We said that the total assets will equal total liabilities plus owner's equity. And here we had the components of a balance sheet, the assets on the left side and the liabilities on the right side. And the current assets in here, then the current liabilities will be on the other side on the right. So the current assets on the left, current liabilities will be on the right. Fixed assets on the left, fixed liabilities will be on the right. Shall see you by the next week. Take care of yourself. Have a very wonderful day. Bye bye, everyone. Bye bye.